Good afternoon, ladies and gentlemen. We're now going to start our discussion about why physical gold and silver, and joining me to share his knowledge on this is Chris Blasi of Neptune Global. Chris, why don't you start off by telling us a little bit about your background, a little bit about Neptune and what it does.
Okay, so Neptune Global is a physical precious metals really platform, dealer, market maker. And I say that because a lot of people will know names, especially online, like APMEX or JM Bullion. We're a little bit different. We've been around 23 years. We have, I would say, do something that no one's done right now. Instead of where my competitors basically look for individual investors to come to them and do something on their own away from their advisor experience, we of course do that, but we also now work with advisors. And the reason when I say that is truly work with them in the sense that their AUM can stay intact. They can trade in physical metals, and what they're doing, a lot of them is they're switching out of ETFs. They're moving into the physical metals because they see counterparty risk that gets eliminated by moving to physical. They transact for us on a daily basis, and we're able to report up into their systems like any other custodian. So typical independent advisor, RIA, basically clears their stock and bond trades through Schwab, NFS, or Pershing. The bigger ones will do it with multiple platforms. We're just another custodian that reports in. So that is actually what we believe, and it's proving to be correct, a very big move, because you're now going into the realm where more of the money is tied up. And of course, not many advisors, as the gentleman told us earlier from Wisdom, are into the metals, but there's enough out there that have hundreds of millions in the ETFs that we're actually getting conversions from that. So, and just to kind of add why physical and why this is interesting, I've been doing this 23 years, and I don't know how many of you follow what goes on in the physical market, but there's been an unprecedented amount of what they call exchange for physical over the last several months. In 2008 and 2009, in the financial crisis, you didn't have that. Big investors were content using a derivative of gold as a hedge for their portfolios. Now those same investors are seeing a different world and are converting to physical. So take away from that what you would, but it's because gold is always driven on what are the macro matters, geopolitical, macroeconomic, and that's kind of at least telling me that we are in a different environment than 2008 and 2009.
Okay. What do people need to know about buying physical gold and silver? I imagine as with other aspects of investment, you need a strategy, you need to execute on a strategy.
Well, so understand why you're buying it. Some people confuse it, right? I mean, I think a good way of understanding gold, it's a wealth preservation play, right? Yes, they want it to go up, but it's about wealth preservation. It's not a stock, right? When people will put out, but it doesn't pay a dividend, right? The reason it's different, and this is why you want it in portfolio, it's not a stock, right? It's not debt, right? You have money, right? You have true money, it looks like gold to some degree is being remonetized, right? It's becoming more and more prevalent in the global monetary system, right? The Bank of International Settlement, we know, has now moved gold from a tier 3 asset to a tier 1 asset. These are not done without a reason, right? And what does that mean? You're seeing central banks around the world building up gold more as a reserve versus treasuries, right? So these are the big drivers for gold. I would also say, and I just share these things because for investors to say, is gold at a peak? Should I not go in it? Retail has been out for 2 years. I mean, they do buy some. We hear they buy it at Costco. But generally, retail investors have not been driving this market at all. It's much higher on the food chain, we'll say. Ultra high net worth, sovereigns, central banks, right? Unfortunately, retail investors always usually on the wrong side of the trade. So since they have not been in it during this whole rise, it doesn't mean that gold's at its peak. It probably is a very bullish signal.
Okay, and I think that's an important point. A lot of people think about buying gold, physical gold and silver as investment, whereas you're perhaps saying it's more of insurance.
I want to say insurance is wealth preservation, right?
Yeah.
At the end of the day, people will say, oh, it's the tariffs, right? So when I came in this business in 2002, our first trade was $289 an ounce, right? Gold has been going up ever since. You know, the mainstream will use just whatever's going on for the moment to give the impression like, well, once this issue passes, you know, gold's done, right? So now it's the tariffs, right? Gold is going up because the debt is growing exponentially in the world, and the currencies continue to be devalued. And when they work through the tariff situation, maybe that'll be a short-term headwind for the price of gold, but it's not going to curtail where it's going. So,
And I guess the aspect there is, you know, gold preserves your purchasing power. And many commentators have spoken of the fact that, you know, I don't know, go back 10, 20 years, you could buy to buy a standard family car would have cost, I don't know, 50 ounces of gold. Today, that's 10 ounces of gold. Preserves your purchasing power, enables you to, as you say, preserve your wealth.
it's not just wealth preservation. I think what it really comes down to, it's the counterparty risk. As I said before, with the exchange for physical, it's the true asset that you can actually own directly, right? Even with other commodities, you can't own them directly, right? Your oil, you're not going to put a silo in your yard and fill it up with oil, right? But this is one of those ones. It's portable, it's divisible, and you can take control. And that's becoming appreciated more now than ever.
Okay. Now, what are the, there's gold and silver comes in various different denominations or formats, rounds, coins, bars, etc., obviously different weights or sizes. What formats are perhaps the best and or most convenient to hold?
Sure, they all have obviously different premiums associated with anything that's kind of a manufactured product, right? The smaller the denomination, generally the higher the premium. That shouldn't be your criteria for why you buy it. You have to look at your individual situation, right? So for individual investors who are actually taking delivery, yeah, that's where coins or very small bars come into play. I mean, I would say for anyone who's having it delivered outside, not being held in a depository, you go with the sovereign coins. They're the best, right? The bigger investors are going to go for the larger bars with lower premiums. So it isn't that one is necessarily better than the other. It's just what the requirements are of the investor.
Yeah, because imagine if you're buying a lot of silver, that, and we were talking about this the other day, weren't we? People are perhaps surprised at the volume, the amount of space it actually takes up if you're buying in large quantities.
And I'll just have to interject this because this is interesting when I said how retail investors really have not been part of the market for the last several years. It happened for a 5-6 week period, and it's easing up a little bit now. But all that time never was the small retail products have a premium that would be higher than a large product. Example in silver, 1,000-ounce silver bars would always be we'd be able to acquire them at very low premiums versus small, silver rounds and that such. For 5-6 weeks, the premiums on retail products were below what the large bars were. That happened in the 1,000-ounce silver bars versus the hundreds and less, and the gold kilo bars versus like 1 ounce. And why was that? That was because of the exchange for physical. That market demands the larger bars, right? They needed the 1,000-ounce silver bars. They don't use 100-ouncers. So again, that's just, I think, very bullish on who is acquiring, and who's putting demand on the market. It wasn't like COVID. COVID was, supply chain, retail investors getting all spun up, and that was not what we have right now. Right, that was a rural retail-driven market. That was not big institutional money.
So when people sort of call you and say, "Hey, I want to buy gold, I want to buy, silver," is part of what you do at Neptune is, you discuss with them what are you looking to do and why, to advise them perhaps on what's the best format to try and purchase.
Yeah, our traders will work with an individual investor like that. We're not investment advisors, but we will, be able to explain, what the options are and what the pros and cons of each, whether delivery or storage or what size, or gold versus silver, right? That mix. When we work on the advisor side, we generally work with advisors who already understand the value of gold and silver, right? We don't go and, because the market's big enough, you just look for the advisors. We look at their ADVs and we see who's buying the ETFs. So we know that they're predisposed. They believe in the gold and silver, and then we kind of talk to them about, hey, we can keep your business intact. You can retain your AUM, but you can also look at what we have, right, and the benefits to that, and approach them from that way.
And Now, you mentioned a couple of times about storage, and obviously and premiums depending on which vary depending on what you're buying and what format, etc. So, can you talk a little bit about what the costs of holding physical gold and silver are? And I guess you've got the initial transaction costs and the ongoing costs.
Sure, that's a great question because I think there's a lot of misnomers. You'll hear people say, "Oh, the cost to carry on physical gold." Yes, there's a cost to carry, right? We use a depository, COMEX, DIMEX approved depository. But interestingly, a lot of people don't realize, because of the volume of business we do, our cost, I'll call it the cost of carry, right? So an individual who owns the actual physical through us, the cost to carry is lower than the management fees on the ETFs. Now, granted, there's a little bit of a premium on the purchase because you actually own the asset, but since it's held as an intermediate to long-term hold physical, you're not trading in and out of it. We basically have based on the size of the account, could be like a 25 basis points per annum versus, one of the silver funds is 58 bips, GLD is 41. So when you factor it in, the cost to carry is actually lower with us than an ETF. So that's something I don't think many investors are aware of. I'm not saying every dealer can offer that, but that's what we do. And that's how you have to compete and bring an extra value add to the wealth advisory world and their clients.
Okay. Can we talk a little bit more deeply about the exchange for physical that you mentioned a moment ago, Chris? You said people are coming out of some of the paper products and they actually want to receive the physical. To me, that suggests there's a lack of confidence in some of the paper products, but perhaps what are some of the reasons for that?
That's what I'd read it the same way, right? So the COMEX, there was it's been, and it's still continuing, a high level of exchange for physical standing for delivery, right? Again, it wasn't this pronounced back in 2008 and 9. So this is, the tell from that is, the sense is that, what's the changes that are happening, whether it's you call the move toward multipolarity or whatever, is that things are lack of trust in institutions, and that includes exchanges. And people are saying, hey, at this juncture, the derivative has a level of risk that, whatever was pitched before about its ease of trade or something, or lower cost, it's not valuable enough compared to the counterparty risk that carries.
Now, earlier this year, reading in the press, there was perhaps part of that as well with the U.S. President Donald Trump. People were onshoring silver and gold to avoid tariffs they perceive may or may not come. So they wanted the metal back home to not be caught up in that. What actually happened there? Is there still those potential risks out there?
The tariffs were talked about as a risk to gold and silver. What we understood, it never materialized, and if it did, it was only going to be for very small retail products, not stuff coming out of London to New York, something like that. The type of larger bars we talked about, that really was not a big a threat. It was really the exchange for physical. There was a lot of 1,000-ounce silver bars being brought in to bolster the COMEX. And they could do that with kilo bars too, because you can settle a COMEX contract with 3 kilo bars.
Okay.
So.
Now, looking at the gold space, the narrative in the past year or two has been there's been a lot of physical buying in Asia, central banks in Asia, Eastern central banks, less so in the Western world. Are you now starting to see this, not necessarily the pendulum swinging towards the Western world, but you're now starting to see the Western world actually getting in on buying physical gold in increasing quantities?
You're right. I mean, the central banks in the Middle East, the Far East, have been buying for a number of years. The West wasn't so much. I think they are starting to now. There's a lot of obscurity of who's buying, right? You see the flows, but you don't know who's actually buying. But when you see the volumes being bought, obviously it leads you to understand they're quite big players. So it's happening with we'll call it, we see a lot of family office money buying a lot of ultra high net worth investors. But again, it hasn't trickled down to we'll call it the small to mid-sized retail investors yet. But I mean, that's the beauty of gold, right? It's a global market. So even if it's a little bit weak here in the US, the rest of the world can help drive its price up.
As we mentioned earlier on, one of the reasons to invest in gold, physical gold and silver, is to preserve your purchasing power. Now, President Trump has made a lot of noise about using tariffs to execute his policies and negotiate the outcomes that he wants with various governments around the world. Tariffs are obviously inflationary for the consumer. Does that create extra, or are you seeing that as an additional incentive, incentivizing people to buy gold and silver physical?
I think that could be something that people say, well, that's why gold is going to go up. I will go back to say, there's always been a reason through the years, as I mentioned, right? I've been in since 2002, of why it's going up. And then that passes, and maybe gold trades sideways for a while. But it continues to go up because at the end of the day, it's the alternative to fiat currencies, and all the fiat currencies are basically continue to devalue, right? I mean, from a technical perspective, some people are into technical analysis. When I got into this business, I was convinced that from the research I did that we're going to go into a secular bull market, right? 30 plus years. It's actually playing out like a textbook, right? From 2002 to 2011, then we had an absolute perfect 50% retracement of that gain, which ended on December 31 of 2015, 16, and now we're in the third leg. Third leg ends up in a parabolic blow-off. I think we have a ways to go. I hope we do, because I think when that happens, the supply will really dry up, but that's what we're in. So regardless of whether it wasn't going to be tariffs, this secular bull market has been in play. And a lot of these, again, things like the tariffs or 2008 are just reasons given during this market for why it's happening, but it's going to happen when tariffs get resolved.
Okay. Final question, Chris. Is there anything we've talked about a lot of different things and a lot of different aspects. Is there anything we haven't covered that you think is particularly relevant and meaningful at the moment?
I would say the one question you did, which everyone does, is what about silver, right? Because it frustrates everyone. I mean, John Fennick was very clear on that, and we see that all the time. I think it's really as basic as this, and it's not punting the question, but silver will follow. Gold leads. It goes back to, they used to say, right, gold is the money of kings, silver of the masses, right? As I said before, the people who've been driving gold will fault the kings, right? The central banks, the sovereign wealth funds, they don't buy silver, right? Silver will come into its own and get its footing, probably not in the not too distant future. But again, the players that are in the market right now are more gold focused.
Okay. And Chris, how can people get hold of you?
So you can learn a lot about us at our website, neptuneglobal.com. And as I said, we work with investors of all types and institutions.
Excellent. Well, thank you very much for joining us and sharing your insights today.
Thank you very much.